Today we're going to analyze Tesla and see whether there's a good business behind the stock, and if so, at what price should you buy? At the end of the day, sentiment is everything. The news drives what people think of the company, and that translates to whether you want to buy, sell, or even short the stock because of what someone else is saying. You can see some of them here, at least the headlines, since they convey the overall sentiment anyway. So unless you actively avoid the news, we're all influenced to some degree by what others have to say. And I want to share this part first because I want you to come away looking at the fundamentals of the business and compare that with what others say. But ask yourself this: we all have a financial incentive. Can the news be biased? Do some or all of these writers have a position for or against the stock? Let's find out with this analysis video. We're first going to look at the company's growth metrics. Why do you want a growing company? A growing company is the biggest reason why anyone would invest in a stock, period. Growing revenue, income, earnings, etc., that translates into a growing stock price. And ultimately, if you own a stock, you want it to go up. So for growth, I'm looking at 5 metrics: revenue growth, operating income, net income, earnings growth, and of course, stock growth. The percentages here is a compounded annual growth rate, and unless specified on the screen, we're looking back at 10 years of growth. Now, to make sense of all of this, a rating from 9 to 11.9% is considered average growth. Ideally, we want these growth metrics to be as high as possible. But there's a downside to that may not be that obvious. If the growth is unrealistically high, we need to be cautious. That means we're dealing with a high growth business that will eventually come back down to earth. And you don't want that to be there when things start tumbling. So be cautious when the numbers seem too good to be true. Of course, if numbers are bad, it's likely not going to go up unless something drastically happens, like some new product or innovation. But I wouldn't bet on something like that to happen. For the grade, the higher the number, the better. Next, let's look at the company's financial health. Why do you want a healthy company? A healthy company is a big determinant in how long a company can sustain its current growth, as well as having the financial strength to increase that growth in the future. So for financial health, I'm looking at 6 metrics, but you only see 4 on the screen: total assets, shareholder equity, cash on hand, and net cash flow. These are the positive health metrics. The other 2 are negative health metrics, and we'll look at them right after. Just like growth, the percentage here is also compounded, and again, we're looking back at 10 years of this type of growth unless specified. To make sense of all these positive health metrics, a rate from 7 to 9.9% is considered average growth. I'm not showing the dollar figures, but instead whether the company is growing its assets, equity, and cash at a decent rate. All companies are at a different point in their business cycle, so looking at the growth aspect is more important. Now for these 2 negative health metrics, we look at total liabilities and total debt. For these 2, we don't want them to grow. To make sense of them, a rate from 4 to 6.9% is considered average growth. However, for certain industries, growing liabilities and debt isn't always a bad thing. Having less liability and debt enables a company to use that cash they have towards growing their business instead of paying back their obligations. So we want a slowing growth rate for these 2 negative health metrics. Let's then look at the company's dividend metrics. What you see here are 3 metrics: the current dividend yield, the buyback yield, and the payout ratio. Basically, for the first 2, we want a high yield. As a shareholder, you want to get paid while owning the stock. That's the only true definition of an investment. The buyback yield is when the company buys back its own shares, so as a shareholder, you're increasing your percentage of the company, and if you could, you'd want to own as much as possible. You can see on the left what the average yield is and where you want the yield to be at. On the right side is the payout ratio, which is basically the percentage of the company's earnings going towards paying you as a shareholder. We love dividends, but we don't want all of the company's earnings going to shareholders. Reinvesting that money into the business will assist and help grow the business further, so there's a give and take there. For the payout ratio, we don't want that to be too high, so the best mix is a high dividend and buyback yield paid out with a small percentage of a company's earnings. Next, let's look at the company's efficiency metrics. We want a company that is using its cash and other people's cash in an efficient way to run its business. So that's why we're looking at 3 metrics: return on assets, return on equity, and return on invested capital. Now, numbers here are current rates, and we can be confident that these will continue going forward unless there's a more efficient way to produce a product, such as a new technology that makes producing something super cheap, things like that. Otherwise, you can see here how efficient the company is handling its assets and cash based on these metrics. For this part, we look at the company's valuation metrics. Now, none of these four metrics, price to sales, price to earnings, price to book, and price to cash flow, indicate whether the company is overvalued or undervalued. That's the next section. These valuation metrics are used as a comparison, specifically with the index, such as the S&P 500. In this case, we're making a comparison between this company and 500 or so other companies put together as part of the index. As a multiple, we want all these metrics to be lower than the index. Here's what I mean. For price to earnings, if a company made $1 in a year and the company is valued at $10, the PE ratio there would be 10. Basically, it's valued at 10 times more than it makes in a year. For a more undervalued business, we want that multiple to be lower. But what you can see on the screen is not the actual ratio, but it's a ratio compared to the index, so we can get a relative valuation. There's no degree of relative difference, but simply put, if the black bar is shorter than the gray bar, the company is better than the index. Before we continue, consider joining my Patreon. It helps support this channel. But more importantly, you'll get access to every company I've analyzed, so you can quickly compare them. It's updated all the time. Head to patreon.com/GrowthShares or click on the link in the description. By now, you have a good idea of whether you have a good or bad business. If this were a private company for sale, we can be confident just from a business perspective whether to buy or not. At the top right hand of the screen, you would have noticed a point system. That's my point system I've tallied up, specifically to determine whether we have a good or bad business before us. Of course, you may have a completely different view of the company. I've had comments from investors criticizing me of having a short position because I give it a bad grade, or even those assuming I have a financial incentive to pump up the stock. Regardless if you're a biased viewer or not, this is what everything tallies up to be. Take that any way you like. So what does this all translate to when it comes to the stock price? Here you'll see 5 different price points of views: the analyst price, the Graham number, the discounted cash flow model from Guru Focus, Morningstar's fair price, and then my fair price. And then when we average out the 5 different fair prices, we can see where we are in terms of the perfect price to buy the stock. For the chart in the middle of the screen, you'll see how much higher the fair price is from current price based as a percentage. So higher the percentage, the more undervalued the stock. I want to say here that the Graham number, which is based on Benjamin Graham, Warren Buffett's mentor, is oftentimes the most conservative of valuations, so you don't be surprised if it's often overvalued. For the analyst price, it's basically the average fair price given by however number of Wall Street analysts look at the stock. I'd say they're more optimistic with their valuation than the others. But I just want to include 5 different point of views so you can compare and pick between which you trust the most. Now, what's the point of investing if the stock doesn't go anywhere, right? It's one thing for a company to have a great business and an undervalued stock price, but it's a wholly different story when it comes to the daily motions of the stock market. Although past performance is no indication of future performance, we all know things usually keep steady, at least until they don't. What you see here is our stock's compounded annual returns versus its industry and versus the S&P 500 over various time frames. This will give you a different way of looking at things. If you're concerned only with how the stock has performed, then you have your answer here. I'm not including this as part of my analysis, but I just wanted to share this since some of you are more interested in the stock returns than the fundamentals behind the company. In the past, I used to end these videos with a final grade, but that just pigeonholes all of us into some simple conclusion to a very complicated topic, such as properly analyzing a company. There are 4 things you can take away from this analysis video. You can see what other people are saying about the company based on the recent news. You can look at the numbers and determine for yourself what kind of business we have behind the company. You can see what others are saying when it comes to the fair price. And you can ignore all that and just see how the stock has performed and go with that. And that way you can make a more informed decision to where you should put your money. So remember to check out my Patreon. Your support is always appreciated. Invest wisely, and as always, take care of your money.